It's cute that you guys are talking about sales marketing and payment processing cost of revenue. That's cute because y'all are missing the point.
It's such an unknown area that not just accountants, but CFOs, FP&A, everybody is getting wrong and misunderstands. And I don't even think really understands the drivers as their underlying business. I've never read a memo that goes to the level of depth of understanding of what we're discussing today, but they should.
Is that right? Which is
Exactly.
That's the elephant in the room.
Welcome to the Gap Savvy podcast. I'm the founder of the Gap Savvy community, the largest grassroots community for industry accountants for the most influential companies in tech. I have over 20 years of experience, including 11 years at KPMG, where I spent time in audit advisory, as well as time with their national office. I went into industry to help scale finance at Glassdoor, where I learned how difficult it was to be a real accountant. And then I helped build an ERP from scratch as part of the founding team at Everest System. I'm super excited today to be co-hosting this podcast with Devon, ex-controller of Google Cloud, financial advisor to the Office of the CFO and CAO, and host of podcast Ambitions Align. Today, we talk about how the accounting world is adapting to a change in the way that all cloud products are sold, specifically how this huge economic marketplace has thrived for cloud providers, so AWS, GCP, Azure, and diversity in practice in the technical accounting, and how it doesn't quite align with the real economics of what's going on. Excited to get into it. Let's get started.
Angela, I really appreciate you taking the time. This will be an experiment for us to really do a deep dive on technical lens of marketplace and principal versus agent transactions. So I'd love for you to introduce yourself, then I'll do an introduction for myself and for the audience.
Yeah, thanks, Devon. Thanks for having me on. I'm so excited to have this topic being discussed. So, intro for myself, I'm the founder of Gap Savvy, an accounting community that brings accountants together that talk about those tough questions, the ones that aren't documented in the implementation guides, but every accountant has to go out there and implement it and figure out how to do it over and over again within their operational processes. I started Gap Savvy way back in 2017 when the ASC 606 was supposed to come out and then was supposed to come out and then was supposed to come out again. At that point, there were so many questions that were in operational practice, and all the firms actually hadn't figured out a lot of the questions as well. And so I thought it would be a more interesting place to bring industry accountants together, where technical accounting was a fraction of their job and such a big part of it was actually operationalizing that and bringing those minds together to kind of work through these tricky spaces. So one thing that has come up quite a bit in the last 5 years, but I feel like there's a constantly recurring question as marketplaces have grown so much, the accounting ramifications that surround a shift in sales behavior and business behavior has just been so interesting because it creates so many operational challenges and so many technical accounting challenges that we talk about in deep memos or within our teams, but we don't really get to express some of the things that I think we all see, but maybe we're not saying out loud. I know I'm supposed to be doing my intro, but I'm super excited to talk to you because of your background. One, because you have this space of communicating, going deep into these subjects, but then also because you are sitting in those front lines of being one of those cloud providers and creating all of the reporting and all the things that other accountants were receiving and trying to account for things. So I think it'll be a really interesting discussion because I've got a lot of the background of the questions that are being asked in this space from accountants. A lot of them have been around AWS, GCP, and Azure, and how to account for all of that depending on how much limited information that you get. And to be able to talk to someone that has been on the other side and has the accountant lens as well is really exciting for me.
Well, I'm really excited to talk to you too and finally find someone who has such a passion in these topics and trying to explore best practices. You already said a little, I'm in consulting with this company, PCG, and I also do strategic advisory work for large companies and CAOs. And you nailed it, hands down. There's not a consistent way that I've seen a lot of this guidance applied across industries or across companies. And it's such an unknown area that not just accountants, but CFOs, like FP&A, everybody is getting wrong and misunderstands. And I don't even think really understands the drivers as their underlying business. So I love the fact that you're interested in this. And when you showed me all your great data of how you're polling, how people are applying this in practice, it was fascinating to me because a lot of it's an even split on divergence on how this stuff is concluded, which shows how ambiguous it is to the industry. But it's important for us to figure out what the truth is of the economic substance so you can actually report it. So I'm excited just to kind of hatch this out with you. And it was fun to find someone else who's been going down a similar vein of research for a long period of time. So I appreciate us taking the time.
Yeah, let's do it.
Let's do it. So top question, I think, first off, you kind of flagged it. We want to set the grounds for everyone here of like, we're going to assume everyone kind of understands a little bit of what principal versus agent is. For those of you not listening, we're going to be talking primarily over relationships that are three-party in this dialogue. So you're selling to an end user on the marketplace. They might have a vendor who then is listed on the marketplace, and then the vendor would get a 3% rev share of the transaction for then listing on the marketplace. The vendor keeps 97%. The end user gets access to the vendor's arrangement. And there's tons of ways this is split up across all industries, right? It's not just marketplace transaction. There's anytime you have a three-party transaction, you really have to do this principal versus agent consideration. Sure.
Yeah.
Yep.
I think principal versus agent has been around forever. There have been resellers, especially to get into specific types of markets. Like if you wanted to get into China or the government, there were only certain suppliers and vendors that they would purchase from. So there have always been this space of distributors within the software world. What I think is particularly interesting right now is that you've got these huge cloud providers that have created these insanely large marketplaces, because every single software SaaS company in the world right now, if they're a cloud company, right, they have built their architecture on top of AWS. And so all of their infrastructure, all of those transactions, everything that happens in their software, they are also paying those costs. And therefore, it's just a really, really powerful marketplace for all of those software companies to buy from each other in this marketplace. I know there's a million topics here, but one of them is that there are these credits, right? So like if you buy from AWS, you get a pool of credits, and like I'm a software vendor, so then you get, 10,000 credits for signing up with your Brex card, right? So there's a ton of incentive for people to be buying on these spaces. And as there have been more and more incentives to, instead of buying directly from a given place, you might as well use these credits or your buying purchasing power within these marketplaces to buy more. And I think that's why we're seeing, yes, there were traditional resellers, but then there are these three giants that can almost make up certain rules to create new accounting issues. We can analogize to what has always been in our world of principal versus agent, which is by far the top SEC comment space within RevRec, right? So it's always been hard. But then to have these three just very large players create these huge marketplaces where when you talk gross versus net and you have that 97 or the 3%, that's a big deal if you're recognizing 100% of that number or 3% of that number. That is a whole entire company. We're not talking about little things. That is a make it or break it of a company.
Yeah. And then one step further, that 3%, depending on how you classify it, if it's selling and marketing or cost of sales, can have a drastic impact on your margin if you're a low margin company to begin with, right? So these are no joke consistency facing issues in SEC filing, right? That if they're altered, you're really going to mess up your investor story. The best place to start, how do you want to, yeah, go ahead.
Kind of feel like maybe we take the parts and we can flip back and forth, but like I'll take that maybe view of I'm the software vendor selling.
Okay.
So I'm a company that lists on the marketplace and I sell my SaaS service. We've seen people dabble in, okay, I used to sell in AWS and now I'm going to sell in Azure and GCP. So as a SaaS vendor, when I think about that, like obviously I took all this time to build my product. I have all my engineering and my R&D, and I'm just listing it on that marketplace, right? And what are you doing for me? You're taking this thing, and yeah, it's certainly marketing for me, right? Because it's listed against all of the other software products. But then you're also processing my payments, right? So you're also going to help collect from my customers. You're going to do all these logistics. And that's awesome because eventually, hopefully, I get that amount of money in my 97% in our example. I would think that because I'm doing all the work and I have my neck on the line of the product that I'm selling, that I'm clearly the principal, or I would recognize the gross of what I'm selling because that's my product. And so in our example, I would think that I would recognize the 100% and I would list my 3% as some sort of cost for me, meaning that my top line revenue, 100, cost of 3, net of 97. Let's not necessarily go into whether that is the margin or but I wanted to start there. What do you think of that? Even on just that piece before we get into classification, give me your thoughts from the other side.
Yeah, so I see that argument, and I do agree that if I was an ISV and going through a marketplace, To me, it feels more like a selling and marketing expense, knowing the other side of the relationship. And so the way that I see it from my competitive analysis with the other marketplaces, I think almost the word marketplace is a misnomer. It's more like partnership strategy. And most partnership strategy has this concept behind it, like co-sell, co-marketing, and co-investment. And part of that overall partnership hierarchy includes the marketplace. And so the whole goal of a marketplace, like from a large tech vendor, isn't necessarily to collect that 3% of the revenue. That goal is to develop a relationship with the ISV in order to have a more direct selling relationship to sell through, which is known as pull-through revenue, of more consumption to their other products. And so the idea is to get visibility of the end ISV's product onto their platform that drives direct consumption. They care about that direct consumption, but more so they care about the partner relationship that could lead to more upsells on commitment contracts and whatnot. That 3% of revenue is just covering the cost of doing business. And honestly, most of these companies kind of know the marketplace is like a lost leader. And so to me, that like it indicates what you just said. Like I completely agree that it's more of an agency relationship from the marketplace, from the big vendor standpoint in these pipes. There's going to be other relationships with other companies, but when we're talking about these big marketplace vendors, I'd say it's more like a principal relationship, and then probably more selling and marketing is really the true substance of the underlying relationship. Tough. Yeah. It's a tough call because there's kind of judgmental ways you can lean and argue each way, but that's my insider scoop on it.
Yeah. First question is, can you define to me ISV for just that acronym so that we can get our acronyms out?
Yeah. The independent software vendor. So that's going to be your just vendors. Good call.
Okay.
Yep.
Okay. So ISV, same thing when I say software vendors, independent software vendors, because I know there's different like offer types and I just want to get that one out. The second point that I wanted to say based on what you shared was that it is impossible to disconnect our conversation with the cost conversation. Because if, from a partner strategy perspective, the whole underlying strategy is not to collect that 3%. Like, I'm not trying to be a reseller here. Like, sure, I'll do your payment processing and sure, I'll list you on my marketplace. But like, I'm not an Amazon necessarily like that. But it's not like a traditional marketplace in that way. It's, I am driving more traffic so that the thing you built on my cloud gets clicked on, used more transfers, more data. All of like my bread and butter actually comes from you being successful as a software company. So more people use your software. So you pay me more fees in usage cost. And the 3% is like a cherry on top. It's like a nice to have to drive the other thing.
Well, you nailed it. You said it kind of earlier in the conversation of like, I get credits in order to consume on Marketplace. Like a lot of times these platforms will say, hey, if you consume on our Marketplace, we'll give you credits especially if you migrate your platform onto Marketplace. And a lot of your commitment contracts will actually let you burn down some of your commitment portion reliant on marketplace spent against your product. So that all of these like combined factors to me indicate, like you said, you can't differentiate the cost discussion from the overall substance of the transaction. It's co-selling efforts, which is kind of why I went to the 3 C's of marketing. They're co-selling efforts together. And you really, at least for these big behemoths, should be kind of thinking of it as an agency relationship and a selling and marketing cost. I think is the best practice there.
Yeah. It made my accounting brain wander into what like accounting guidance you'd go into. And usually when we're analyzing these, we go straight into ASC 606, agent versus principal. But there's almost this like collaboration.
Collaborative right? arrangements.
Like, which we're not going to go into at all, and nor do we think anyone should go into. But the reality of it is like you said, it's co-marketing. Like you win, I win, we're both selling together. But I think it's just an interesting underlying because nobody goes to collaborative arrangements here, right? Yeah. We all go into agent versus principal.
Well, I've seen it in practice. I've tried to argue in multiple companies of like scoping into the collaborative arrangement discussion, especially with partnership constructs. There's this concept of like a partner award letter or a partner letter that normally is part of you onboarding into a marketplace transaction. If you're going to enter into a large commitment contract, you're also probably going to enter into a partner transaction. So you become a ISV, you become a vendor, and you become a customer at the same time. And part of that vendor relationship, that partner relationship normally covers those 3 C's, the co-sell, co-marketing, and co-investment. So that might be your MDF fund for your co-marketing. it might be. But when on marketplace, sometimes there's like interchange of like balance of trade initiatives where you go into the payments to a customer, like I'll buy some of your stuff, you buy some of my stuff. Question is it shelfware on product or actually useful product? Is it fair market value? And then you're going to have the question that I think you're kind of getting into of when we're doing this, like these co-investment, are we going to be creating new products together? Like, are we inventing something new here? I was quite shocked. Most of the time when I would bring this to auditors' attention or through any of my implementations, almost no one went there. Like, everyone's like, nah, this is like, it's too soft around the partner language. A lot of it is kind of like, hey, there's MDF. We don't really know what it's going to be spent on. We don't know what we're going to, there's not like set roadmaps or deadlines. So most of the time it was scoped out. But I do think that the substance overall kind of leaned towards collaborative arrangements. It's an area of the guidance that needs to be explored more because these relationships are becoming more incestuous, right? Like they're becoming so intertwined where like the customer and your co-developing product and your co-marketing, like at what point do you have to disclose more?
Yeah, I stand corrected. I like tiptoed around it so much, and then you're like, oh, I've actually argued that. Like I've gone into collaborative, but I've never found anyone there. When you're reading the letter, right? Like because you know more of the background and the substance, and you're like, but this is what we're really trying to do, which doesn't feel that soft to you, but maybe reading it as a vendor, it's like that's too soft. Creates a little bit of what probably we're feeling, which is like as accountants, we've said, yeah, okay, that's in there, but we're not going to go there. Yeah. You've obviously tried to go there, which means that there's a there. But at the same time, the accounting world has kind of shifted. And I would then assume, maybe even as we have this discussion, you're right, there's more to be explored in that space of when that line gets crossed and you have to go into collaborative arrangement territory. Even now, maybe there is some sort of consensus in that it's there, but it's not hard enough for us to bring into the evaluation of classification or any of those other topics yet.
And I don't think you stand corrected. I think I just like it going down these rabbit holes, but I'm curious from an industry standpoint, I would agree with you that most people don't go down that rabbit hole. Most experts that I've met and the ones that have, it hasn't been fruitful. And so I question like you said, I think that's an area of guidance that needs to be more clarified and understand like what we're trying to accomplish with it and eventually enhance disclosures around kind of balance of trade and collaborative arrangements overall. That'd be a really interesting discussion point to hone in on and get data on.
Yeah. Awesome. I'm going to switch gears for a minute because I think that's a really fun thing to look into and maybe future project wise, but let's go into the classification question a little bit about that 3%. Let's say that's the fee. We've, come out of collaborative arrangement world. We've ended up on, okay, I'm the seller. I'm the principal of this thing. I have to pay you this 3% fee. There's this huge ongoing, discussion of, is this a sales and marketing expense or is it payment processing? And the reality is both are kind of happening, plus maybe even some deeper partnership stuff. And some of the arguments are, of course, okay, we're marketplace, we're co-selling, they're part of our sales team. That should go into our sales and marketing expense. Versus, okay, but actually what you're really doing is you're also processing my payments, you're collecting for me, you have all of my customer data, you handle all of the rebates, you handle whether they bought it through credits, you do all of that, you do the collections, and you remit the net amount to me. And so where should I classify that? Because if I put it in payment processing, people put payment processing in different places. A lot of people might argue that payment processing is a cost of revenue, meaning this is just a cost of me doing business. And If I put it in cost of revenue, then it means that it gets taken out of my margin, right? So it's above the line. And so most investors look at margin a lot more heavily because it's like, how's your real operating business? And if you put it in payment processing and then said, okay, payment processing goes into cost of revenue, my margin's not going to look as good. But, if I was selling something and using Stripe, I would definitely put it there, for example. But we're talking about a marketplace that's a little bit more complex. And then maybe one other point is that even in payment processing, some people are split. Some people put payment processing in cost of revenue, but some and we've gotten this through the polling in GapSavvy as well. Sometimes people even put payment processing in sales and marketing, maybe because every payment processor, there's every incentive to make that thing more valuable to the people on that payment processor, even if I am, for example, a Stripe. Like, I might as well help people sell more, because if they do better, I do better. So maybe let's dive into that a little bit more, of that sales and marketing and payment processor and cost of revenue split, because that's a big deal. Am I in gross margin? Does it directly affect my profitability, or is that below the line, and is it just OpEx if it's in sales and marketing?
Yeah, no, I think it's a great question. And I'm trying to think of the best place to start on how to classify. I want to say, first off, I completely agree. I think it's an interesting aspect of marketplace that I wasn't expecting, of what a huge flow of funds business it is, right? At the end of the day, there is a lot to manage, and you have a lot of risk beyond just like classification risk. You start getting state tax risk, because you have flow of funds that are recognized at the state level, and then you have to figure out tax remittance. So there is actually a whole business model behind just collecting the funds. And for me, when I came into the business, I always thought of agency as, you really shouldn't be collecting the fees. It's really just you're arranging, and you should get that 3%. But like you said, what's happening in the industry is most of the time, these companies are collecting on behalf of the ISVs and then remitting payment to the ISVs. And then there's questions contractually on, is there risk associated with those collections? How is the risk passed through? That there's timing aspects. How do you collect? Even when you're talking about hundreds of millions of dollars, even if it's a few days of timing, your treasury department can make massive amounts of interest or hedging based off of that. So to your point, I do think there's a strong argument that at least a portion of the 3% could be cost. The question is then, how do you value and differentiate operationally between the selling and marketing cost versus the actually cost of sales of providing the transaction? Because I'm aligned with you. If you're Stripe, I could see the selling and marketing argument, but I find it a little harder when like you couldn't have done this business without using this payment processor, right? So I see like how it's a little harder to argue the selling and marketing expense, especially. I mean, I guess maybe you could have done the business. I guess I'm thinking out loud, but I don't know. I know it's a tough one. I don't know the classification. I think that's the rationale. It's a big problem because there isn't clear guidance, and I can see judgmental ways to argue kind of either way, right?
Yeah, let's stick to payment processing for just a minute before we go into some of the other ones. So in just the payment processing word, you use this word flow of funds. Yeah. And one of the questions that came up in GapSavvy a couple months ago was, there was this peculiar change in contract language. And to the extent that you could speak of it, it was language that clarified more explicitly that cloud was acting as a payment processor. And that's reasonable, because that's what it was doing. And every cloud company is doing the same thing. But it triggered this conversation in the accounting community of like, wait. If they clarified this in our contract, does that mean we have to then account for it as a payment processor? So what did that what was the thought process? Like, was it a nothing burger, or was it something that should have created an impact on?
That's fascinating. It's such a fascinating bridge. It's actually mainly a legal clarification, not intended to be an accounting clarification. And so you'll see there's kind of nuances between all of the major agreements, and they've changed over time with the big companies. But this clarification of, are you a merchant of record, or is it like a true agency transaction legally, was kind of a question for the global payments compliance. So certain countries require different banking regulations when you're managing huge amounts of funds, because these marketplaces are sometimes transacting billions of dollars annually. It's not a small business unit by any stretch of the imagination. You have concerns about anti-laundering. You have concerns about tax remittance, and not just local, but global. That was an enhancement to the contracts to make sure that we had best-in-class global contract to meet the laws around that as these marketplaces expanded. Most of these marketplaces didn't exist 10 years ago. This has been immense growth, especially over the last 5 years. And when these were built as businesses, especially depending on the business unit, most of the time they weren't planned to be this size. And so once they reached a certain size and global regulators started noticing, the legal team started shaping up and being like, how can we really make sure we're doing best-in-class legal interpretations? The substance of the transaction didn't change. Mm-hmm. It's just a legal interpretation or legal protections around the transaction, but the substance remained the same. of us essentially moving us facilitating the sale of end user products. A lot of times we never even hold them, right?
Yeah. It's almost like we were running this experiment to create this marketplace, and then it just kept growing and growing and growing. And at some point, you get so big and you're transacting so much money that you start acting like a financial services company, right? Like, so you're acting like a Visa or a MasterCard or a bank or a payment processor where you're just, there's like interchange, there's like the treasury, the hedging, right? You're just sitting on so much money that overnight you can make so much money.
Yeah.
You're this middle space where a whole bunch of other laws kick in, right, that protect those other consumers, which, although not intended to be an accounting change, solidifies your space in another type of company, i.e. more akin to maybe a payment processor, right? Where you're like now held to the regulations, the standards, like you said, the fraud, the money laundering, maybe
Liquidity,
some of those.
yeah, liquid state, that kind of stuff, making sure you have enough capital to pay if something happens.
Yeah. And does that also affect, because one other question that's come up a lot in the community is just the ability to have visibility into their end customer information, even if you're just doing like AR and collections, like who's the end user? What email are they transacting with? What customer is this coming from? What payment should I apply this to? Does that also affect, like if you're cleared the payment process, does it also affect the information that can be shared? Like your, like, is it PII? I can't remember what all the acronyms are right now, but like, yeah.
Right.
But like, does it mean that you have to hold your information so tightly because now you're classified as one of those types of companies like financial services or merchant of record and basically kind of like a little bank?
Yeah. So I'd say regulations are comparable. And then what's fascinating is, well, at least in the big companies, right, you'll have business units oversee aspects of business units, payments compliance organization that would also oversee the marketplace organization, and maybe different types of data would be sent to those different business units. And so more of a matrix style organization in order to protect the data was key. And making sure we kind of aggregated the data, like liquidity and whatnot for regulators at an appropriate level that anonymized it was huge too. But I think to your point, it's an interesting exploration here of like, does that make us more of a payment processor that we had to stand up all of these processes in order to meet the requirements in order to continue the business unit? Yeah. And like in substance, yeah. And so then to your point, does it actually analogize closer to cost of sales potentially? And I don't know where you draw the line, especially I think it's interesting because that's 3%, but what if it was 10%? I think we'd be a much more productive discussion of like the materiality of the impact. But even 3% on margin could have a huge swing. So especially a 5% margin company and then 3% added on or subtracted could have a huge, huge swing. So it's a good question. I don't think it's explored enough on any technical accounting lens. I've never read a memo that goes to the level of depth of understanding of what we're discussing today. But they should. I mean, that's our jobs. We should understand the substance of what we're purchasing or why we're purchasing it.
Yeah. But I also think that, how inefficient is it for every individual company that's selling on these marketplaces to do this deep of a deep dive as opposed to having a consistent lens of it? Because we just went super deep into this payment processing side, but you also just explained that there was literally a full department of the payment side and another full department of human beings and resources and costs that was going towards this marketplace side, right? So one, within the company, you're making decisions of who gets what information. I don't even know who that middle person is, right? Of like, oh, you get this data, we got to aggregate it here. So like this data can know this data. Your marketplace people are dealing with the actual vendors that are like, I can't figure out who my customer is. And those are two totally separate departments that legally you've kept separate specifically to meet these requirements of anonymizing data, making sure that information doesn't get out. And then out there in the rest of the world, you got this marketplace team that's trying to work with all these ISVs.
Yeah.
Right. And so maybe let's take our lens of going out to the marketplace side and maybe to frame this discussion, I'll share a couple of the polling results that I've gotten through GapSavvy over a period of time. And I'll compare maybe two results from a 2021 poll and then a 2024 poll. And that is, where do you classify these marketplace fees. And at one point in 2021, I got a result where 45% recognized it in cost of revenue, so that would affect margin, and 55% recognized it in sales and marketing, essentially in OpEx. And then fast forward that to 2024, and what's interesting is that it eventually shifts. And so in 2024, when I redo this poll with the community, I'm now seeing that more people are putting it in sales and marketing, not by a ton, but 57% going into sales and marketing and 43% going into cost of revenue. So even as the marketplaces are evolving, right? Because if we think about that core intention that you mentioned right in the beginning, which is we want you to succeed. We want to partner, co-sell, those 3 C's, right? If that's really what I'm doing, it makes sense that as that as I grow, I might start doing more marketplace selling type things. And so I find it to be interesting that within 2021 to 2024, I can actually see that shift in some of the accounting language. And whether that is a straight, I've decided that maybe I'm definitely going to put it in cost of marketing, which again, beneficial for showing your profitability, right? It's below the line, your cost is below the line, doesn't affect your margin. So if I was a company, I'd be like, if I can rationalize it there with the responsibility of a great accountant, that seems like a great place for that thing to live. And if it's in payment processing, that's a fine place for it to live. I've also heard of people, and this is not showing in my polling, but different companies have also rationalized splitting that 3% fee or whatever that fee is into a percentage going into payment processing or cost of revenue and a percentage going to sales marketing. So I'll lay out that background for maybe our next segment of let's talk about sales and marketing, about what goes on in that space in terms of, okay, like, how does this make sense in sales and marketing? What should we think about there?
Yeah, no, it's a really interesting. I'm curious from your perspective too, because I would say we're playing with one interesting variable as we go into sales and marketing of like, we're anchoring on 3% or 5%. There's discussions I've heard between multiple groups. What if it went to 1% or is it 0.5% or 0.1% because of the selling and marketing benefit to these companies? And that like, not just to these companies, but also to the partner. In this case, it would be Amazon or whatnot. And so maybe that would argue the selling and marketing more. And so let me kind of frame for you how I understand it. And I'm curious on your perspective. But let's say I'm Amazon and you're the ISV. And I'm going to say, hey, you're Salesforce, I am Amazon. Hey, Salesforce, I want you to enter a cloud commitment with me for $1 billion for 5 years. And I'll give you all your services, all your cloud services. I also want you to put your products on my marketplace. If you put your products on my marketplace, anything that you sell through the marketplace, that is my product, I'll count against that commitment. So you get to reduce your burn rate, which increases, and that's maybe your margin. And I'll give you some credits in order to do it. But I want you have to sell it on the Amazon marketplace. And anything that you sell on the Amazon marketplace also has to be linked to an underlying Amazon SKU. So it has to, sorry, go ahead.
Yeah. No. I want to clarify it because I want to make sure I understand the trajectory. So you're saying if I'm Salesforce and I built my product and it's on AWS, and you're also listing my marketplace, whatever you sell, I will give you credits. So my AWS funny money, sorry, not real, you know what I mean. So my AWS credits so that you don't have to pay me as much for the cloud costs. So now we've moved into the cost side, which is I pay you, I'm gonna go round number, I know this is very small, I pay you $1 million a year, but because you also sold on my marketplace, you only have to pay me $700,000. I know that's a very small number for these places, but I just try to go with round numbers. Is that right? So the credit you're talking about is so that my cost goes down as Salesforce.
Cost or your obligation. Okay. Because what these Salesforce might do is they might enter $1 billion contract and they might get a 50% discount to get into $1 billion contract compared to a 30% discount if they got into a $500 million contract. So that extra $500 million of consumption that they're committing to over 5 years is going to give them a 20% incremental discount. Now they can satisfy that 50% with the marketplace offering. So they might get extra credits, but they also get to burn down we call burn down their commitment without paying for it. They're having the end users essentially pay for their commitment, as long as Amazon gets their cut of the cake by driving the consumption of those underlying workloads. And so that's how interrelated and complex these transactions get. And I'm kind of just brushing the surface. It gets a lot more complex than that. But first we start, who's the customer and who are we talking about here? Well, in Salesforce, we don't want to get it confused of like, sure, Salesforce is also Amazon's customer, but now Salesforce is selling to an end user, and then Amazon's an agency kind of relationship in that. Amazon is helping facilitate that sale by putting it on their marketplace, not doing much more, and helping with the payment processing. And they're marketing. Like they're entering these co-marketing relationships where they're saying, hey, by you committing to us, we're going to give you, like, you get the advertising space of being on it. Normally there's going to be a co-marketing effort of like, you get market MDF fund associated with this. And the main purpose of the transaction, kind of evidenced by the Amazon relationship, which is a point I want to get to. I'm like, you need to understand both the partner relationship and the end user relationship in these three-party transactions, or you really get lost in the weeds. Amazon's main goal here is evidence that all they're trying to do is get new end users to understand and consume on their platform. Like at the end of the day, the marketplace is just a funnel in order to bring more transactions onto the cloud, to drive cloud consumption. So for cost related to that, seem very selling and marketing-y. The question is, where's the benefit for Salesforce? What marketing benefit are they getting through this transaction? And then there's a follow-up question on like, what do we do with that cost offset? Is it just lower revenue? Like, I mean, it's a lower revenue for Amazon, like the commitment values, but for Salesforce, should that cost offset be captured anywhere, or is it okay just because it's netted out, right? There's so many threads to unfurl that no one goes into the detail on.
Thank you for bumping up the numbers from my millions to your billions. So I appreciate that.
Sorry.
No, that was appropriate because mine wasn't believable. And just for our recording's sake, obviously we are not talking about real Salesforce or real Amazon. We are just explaining the
even for Google,
topic.
And anonymizing stuff.
Yeah.
Right.
This is just it's very complicated to not use names to make it understandable. I actually think that's part of the problem in the accounting guides, because you have to understand the type of relationships to get through this. But it's that inextricable connection with the cost side, and that there really are, at a minimum, but definitely more, 3 points of key value. The two that we talk about in accounting when we get to revenue, which is the payment processing and the sales and marketing. But actually, both of those are dwarfed by the real strategy, which is to drive cloud consumption, which makes money for, in this example, Amazon, and in many ways also makes money for Salesforce in this example.
Exactly.
Because cloud costs, after engineering and headcount costs, are by far the largest cost for any SaaS company.
Mm-hmm.
So Correct. It's a quote unquote savings, and you hit on one thing, which is it contra revenue or is it contra cost, right? Which I've seen questions dabble in it. I haven't personally been a part of getting to the end of that rabbit hole, but I suspect that people are doing it differently because, again, these are all made up structures that have happened as people have created strategies, right? Like, so as marketplaces have grown and they're like, well, what we're really trying to do is drive cloud consumption. Like, and I'm going to say cloud cost consumption because if I'm the point of view of in this example, Salesforce. But Amazon is trying to, like, that's actually where they make their money, right? I want everyone to build on me, and I want them to be highly successful, and I want all their users to be clicking on stuff and using their product, because then you're going to consume the usage, you're going to consume and use the cloud underlying that everyone's software product has been built off of. Is that right? Which is
exactly.
That's the elephant in the room.
Exactly. That's the elephant in the room that no one's talking about.
Yeah.
So what do you think? What do you think? Is that selling and marketing or cost of sales?
No, okay. I got to go back to one thing because you also mentioned one thing. I'm going to say right now in our conversation, I'm completely split.
Yeah.
Only because you've thrown this elephant in that tells me, oh, it's cute that you guys are talking about sales, marketing, and payment processing cost of revenue. That's cute because y'all are missing the point.
Yeah.
But we don't know how to account for that yet. So we're going to put that to the side. You mentioned one thing, which is at one point, there have been discussions, and this is consistent with what I've heard in the community, is that at some point we said maybe it should be a 10% cost. So instead of the 3%, 10%. But I've also heard that over time, those fees have been reduced off of all three cloud.
Yeah.
Right. So maybe it was higher, the rev share was higher, and then they're like, nah, it's cool. Like, let's just make it 3%. Like, maybe like renewals, maybe 1.5. Let's just bring it down to 1, whatever. And my perspective, like, I just want to clarify my understanding there. What is the incentive of saying, I'm going to make it lower? Is it because it's totally fine if I make the percentage lower, because that was always the cherry on top. I don't care if I get a half cherry or a quarter cherry. Like, that was never the point anyways.
Yeah.
I just want you to sell on me.
Yeah, exactly. It was always perfunctory in the first place, especially for these large companies. It's kind of funny money at the end of the day. The main goal is the pull-through revenue. So driving like underlying consumption. And so let's zoom out to the strategic. What are these cloud companies doing? There's a land grab. And how do you win the land grab of getting the most business and saturating the market? Well, you give incentives to customers. One of those incentives could be signing up on Marketplace, and the other is adding the value of you can now buy Salesforce's, again, anonymized, Salesforce's products. If you are GitHub or whatever, GitHub could buy Salesforce's and burn down some of their commitment because they're buying stuff on the Marketplace. So now there's an incentive to use Amazon because they have this holistic community that automatically use their products and are attached to their consumption base. End users who might get incentives, the partners might get incentives in order to use the Marketplace. Now they're all stuck on Amazon. And now Amazon wins the bigger land grab, which where's the real value? It's the underlying cloud consumption. And then ultimately, like where we're going with AI and whatnot, and the underlying consumption of those tools. And so that's the whole strategy, is more of a selling and marketing effort from these ends. And so you nailed it. Like that 1%, 3%, 5%. Was just kind of competitive benchmarking at the beginning. A lot of the time budgeting for departments of like, hey, how do we justify the pull-through revenue, especially in the early stage of a Marketplace transaction? If you're the GM, how do you justify growing your staff if you can't, like, it's not easy to figure out your pull-through margin in something that complex. Well, we need 10%. Let's do 10% sale, and then we keep that and we can start figuring out our budgeting, like the 10% rev share. As these organizations got more sophisticated, they realized the real value is in the pull-through, not that rev share percentage. They came with some example metrics or benchmark best practices that you can find on what the best pull-through margin is for every Marketplace sale. And then they kind of benchmark their organizations against that number instead of the rev share. And so that rev share becomes non-consequential over time. Yeah.
You said so many things there, and
yeah, I'll slow down.
It was so good.
Yeah.
The learning over time in terms of, okay, in the beginning, 10% was like just to cover my costs. I need to rationalize that I have to build this department. I got to have all these collectors. I got to have marketing people and building communities, making everyone feel good. I need to make sure that I can cover the fact that I exist because we think this is important. We don't know how important yet, but I got to cover like literally the humans that I'm hiring to operationalize this thing that we've built called Marketplace.
Yeah.
Is that right?
Yeah.
And then over time, you're like, ooh, like, so glad we built this. This is really working. But it's working not because I'm going to just say, let's just say the department's 50 people. Because these 50 people are making so much money, off of my 3%, 10%, 5%, whatever it is. It's not that. It's that I can now connect my data points and say that because I created this department and because more people are selling on me, I am driving my pull through consumption. I think that's the word you like, right? It's pulling through my other business line. I'm pulling through the cloud usage, the consumption, and more people are getting more customers that are clicking on more things and using my product more. And that pull through from that other department, that cost side, or sorry, not, cloud consumption side, that's the real winner. So at this point, I'm like, let's say I'm 5 years in, I'm like, oh, that was cute. I'm so glad we covered our budget for 50 people at this, whatever, 10%. Y'all are doing great. We just want more. We want you to drive more. So instead of 10%, let's go to 1%, because let's just get as many people as we can, because the real win is the pull through. Exactly. Is that right? So you're basically saying, yeah, you might really be doing sales and marketing. You're actually doing it so well, we don't even need people to pay for you anymore. because someone else is paying
Exactly.
for you.
Exactly. The way I think about it too, I always go back to the credit card analogy. Or like when you're doing a referral in the professional service world, there's so often that like, hey, if you refer me business, I'll give you 3% of the total contract value. Reality of business is no one does that. Like no one refers each other for small percentage of the transaction value, like 3% or 5% or whatever your contract value is, because it feels like you're changing your business model. You're changing to like a credit card fee. Like, hey, I refer your friend to Visa and you get a $3,800 bonus. That's not the business, right? Like you're not in the business to make the 3%. You're in the business to sell your service. And the real value from referring a friend or from building a partnership relationship isn't in collecting a little bit off the top. It's on future referrals. It's building the ecosystem of like you and I, if we're professional services, you're a lawyer and I'm finance, and I give you a good referral. The best thing that could happen is then you give me a good referral, because that might be a $100,000, $200,000 project. I don't want a 3% fee on a $100,000 project. That means nothing compared to one referral. And so the question in these ecosystems is, from a partnership strategy, how do we build an ecosystem that encourages more consumption of the products and gets away from just like these transactional level relationships?
Yeah, I'm gonna jump somewhere that I don't know if it makes sense, because now
Let's do it.
the question of payment processor, sales and marketing, like if I shift my mind to the ISV, or I'm the software vendor now, which is like, cool, awesome that that's your strategy. So glad it's working out for you. Then I think about that's cute, and I still have to classify this thing. And
Yeah,
so
exactly.
whether it's 3% or 1%, I still need to put it somewhere in my financial statements.
Yeah.
So now knowing that that's the strategy, which is you won so hard, right? Like you did so well on cloud consumption. It must mean I'm winning too,
Yeah,
right?
exactly.
Because, and so it's like, again, this is now I'm going in just full, pontificating, but the payment processing fee or market, the reality is you're getting both. And you have to classify it. But what value do I get in our example as Salesforce, right? Like the reality is I get both. If I get both and I don't want to split it, is it more one than the other? If the cloud company made a ton of money, it means I made a ton of money. In that particular scenario, I'd be like, cool, and I got someone to collect for me. That's starting to feel more like the cherry on top, to be totally honest, which is like, you did well, I did well. We partner sold together. You got people to use their credits on my product. Awesome. We went out there and we made sure everyone's integrations worked and my software works with everyone else's software, and you won and I won, because that's the whole point of a partnership. Then it's feeling more like, what really happened was, yes, you did get some of your operational stuff out of the way. You got your payment processing, your collections. But what it really tells me is the economics underneath it is we helped sell together. We came to this together. And because of it, we both made more money out of it. Now I'm leaning more on that side, because the economics are, if you won, I clearly won too.
I think that makes sense on how I'm seeing it. And something that could substantiate that is the way these work in practice aren't as simple as we perceive. But when you list something on Marketplace, on any of these marketplaces, it's not like the head of Salesforce goes on to Marketplace and goes, oh, I've been looking for this forever. This is my solution. Oh, I'm so glad Amazon put this on. I'm going to buy billions of dollars. That's not what happens. Amazon will have salespeople who help Salesforce identify, or help whoever it is who's selling the Salesforce product, identify end users who will then use the Salesforce product. So the sales teams will work together. And sometimes Amazon and these other companies will find sales members to work across boundaries. They'll imagine you're working for Amazon, but you have a portfolio of partner clients that you're also selling their products. Being like, oh, have you heard about GitHub? Like, hey, make sure you use it on Marketplace. And when you're in the GitHub, hey, by the way, have you heard about Salesforce? Have you heard it's on our Marketplace? And we can get you a discount if you talk to them. And then we can give Salesforce some credits. So going to substantiate like everything, all the money, kind of, if you follow the money, the money's all going to selling and marketing costs to support this. I'd say the cost of doing the payment processing is almost just a incidental. Like it's not small, but it's more of an incidental, like the way they built these things, they accidentally built them. Accidents might be a strong word, but either I'm not sure how intentional it was of thinking, oh, we're going to do payment processing for these large companies. It was more like, hey, we're trying to stand this thing up. And the easiest way to do that is to collect money on these other companies' behalf because we have the systems to do it.
Yep.
The real goal is elsewhere, right?
Yeah. It loops back perfectly with what you actually said previously when we were talking and we went down payment processing world. You said it might have started out as a small business, but it started transacting billions and billions and billions of dollars. And suddenly it became so big that legally we had to define what we were doing here because it was successful, right? So maybe we started out here and we didn't build a payment processing company. That was never the strategy, right? That was never the strategy. It was a means. I wouldn't say it's a means to end, and it's not like accidental, but it is like, I think about how do you track pull through, right? You need certain data points to be able to understand pull through. At the end of the day, this data game is kind of insane too. We haven't touched on that, right? But like you need certain types of data to be able to connect that data to create relationships, to understand how you're doing, where you're going, what's working.
Yeah.
And one of those data points is you need to know how much is paid.
Exactly.
And how do you get that data? You process the payment.
Exactly.
And maybe that comes with some annoying consequences like sales tax, which everybody hates. But it's worth it because if your pull through is that much, like, sure, I'll build that. Right?
Exactly. You're nailing it. Now, here's an interesting piece. We could go on tangents forever, so we'll eventually figure out when we land this plane and what we do next time, if you'd like, is, well, there are going to be companies that take advantage of the payment processing. Like, there are going to be companies that realize, hey, there is a real value that these companies are doing the invoicing and flowing all of these transactions. And now I can see if I was to go be an auditor or technical accountant for one of these companies, that's where I think I would hone my argument when I'm doing cost of sale versus selling and marketing. I think my default, like we said, is like, I'd probably default to selling and marketing. But if I was starting to see like them playing with these concept of private offers and starting to do things like Amazon's, and I'll explain what that is in more detail, like Amazon or any of these major marketplaces, they might allow things like prepayments through their system. Like you might be able to prepay through the system for a few years, but the invoicing might happen at a different, like the invoicing from the vendor to the invoicing to the partner could be different, like different timing. And if someone smart in treasury or some smart controller or CFO figured out those nuances and started taking advantage of those systems, like, oh, we're doing prepayments through marketplace, but we're paying in arrears to the big marketplace vendors, then maybe it's more of a payment processor. Like maybe there is more of a cost. Maybe you're gaming the system in a different way. And so that's where it kind of goes, what's the real substance? What is the purpose that that partner of that transaction is actually using the marketplace? Like what's the real goal here? I think really does matter, which is the judgmental area. But man, it's hard to figure out.
Yeah, that's a whole new ball of yarn that I'm so excited to explore because there's this awesome community called FinOps, right? And if I had a community crush, that'd be it from the savvy perspective. And it's a community where these FinOps experts, which talk about cloud cost optimization, cloud cost, like even getting to the point of like working to define how the reporting in the field structure is so that across these clouds, people, like payment processing. And part of the projects that they've done is like, what do you do with these prepayments, right? What do you do with these large consumption upfront buys, which obviously, again, context, this is the largest cost for most of these companies.
Yeah, exactly.
Outside of payroll. So like, this is the whole ball of yarn minus the people that have to do this. And just because why not talk about AI? Where does AI sit in this? They're just tokens on top of these cloud companies, right? Like AWS, Bedrock, like all like use the LLMs that like, so it's all gonna be tokens, it's all gonna be more usage, it's gonna be more of this complexity. And if that's the case, then The strategies on I pay up front for 3 years, but maybe I can game the system of charging my customers and strategically doing that. To me, actually, that just sounds like cash flow management, which right now I'm like, that's fair game in accounting world. The only thing that happens in RevRec world is that annoying significant financing component, but that standard doesn't cross over the cost side. So like, we're going to pretend that's not there.
Yeah.
Maybe one day someone will connect this because it's inextricably connected, right, with the cost side.
Especially if you're doing 5 or 7 year prepayments, you start getting really fuzzy. Yeah.
By the time you get to 5 to 7 year prepayments, especially if you're doing off of consumption, right? Because another large ball of yarn is that like prepaid consumption balance, like what happens when you get ahead of your invoicing or behind of your invoicing, because who knows how, everyone hopes they're going to do well as a company and they get tons of consumption, but they might not. And so every one of those consumption contracts and every year, usually there's like a defined commitment for year 1, year 2, year 3, or maybe it's a lump. Everybody negotiates it a little bit different. And I'm sure everyone will learn as actual behavior rolls out. But the accounting side on that huge ball of yarn, which is I call it the usage consumption accounting debacle.
I like it. Good
Because
term.
that is absolutely a real thing, which maybe should be the next deep dive we do.
That would be fun.
Yeah, because that actually really starts to connect the dots on that cost side that nobody is talking about, where the consumption piece is everybody's paying all the vendors underneath them. Right? So like if AWS, GCP, and Azure are consumption-based companies, which they are, right? None of those companies are like, just pay me this flat fee of X amount for a year. They're like, you just pay for what you use. They are the heart of the consumption, debacle. Because then any company that sits on top of them also has to come up with their own pricing, right? With their own customers. And then they have to manage that space in between, which is their own margin, right? Which is how much am I going to charge? Can I move to a revenue consumption usage model that somewhat aligns with my own cost structure? It means that within those companies, each individual company has to be able to connect their own data points
Exactly.
into how much they bill, payment processing, right? And how much they use in cost, which is what these large cloud cost providers have optimized over, let's say, 5 to 10 years. I'm just making up a number, right? Like over time, they've obviously gotten better. Over time, they're probably more in the sales and marketing side because everyone's obviously been very successful. But that took years. And companies that are building on top of that can't necessarily connect those dots yet with their actual cloud costs and how they are pricing their own products, whether it's usage consumption model or still stuck on this subscription model.
I think it would be really fun to do a deep dive on that. And I think there's a ton of, again, another broken area. I don't know, broken is probably a strong word, but it's a very misinterpreted or judgmentally applied area of the guidance on not just the cost side, but the revenue side of it too, of like subscription versus consumption-based and ratable versus like percentage of completion versus do you have to do consumption-based? And then are there any systems that could actually do any of this stuff we're talking about? I haven't found anyone. I think Everest is trying to do something that's about as close as you can get, but I've worked with the Oracles and the whatnot of the world on talking through these use cases, and they don't have anything that can solve for this. So it's a whole new world of accounting.
Yeah, absolutely. And I'm also connected to Everest, and there are many, like I feel like there's a million startups right now that are trying to solve this consumption problem. Whether it's misinterpreted or wrong, I just think that this is a space to explore. Just in funny background, one of the key drivers to creating GapSavvy as a community initially was because when I was at KPMG, I worked on the ASC 606 adoption specifically for payment processors. So like your Visa, MasterCard, Discover, like there's just credit card companies that did something similar enough. Yes, they're competitive, but overall, the question really was, if I have a 30-year contract and I'm going to transact all of these different types of debit, credit, fraud risk, FX, lots of different types of usage, right? If I have a 30-year contract, do I take that contract and estimate how much money I'm going to make in 30 years and ratably straight line that, which is a conclusion that you can get to under ASC 606, right? Under the variable consideration standard, it's, you signed a 30-year contract. Yes, it's variable, but why don't you estimate out for 30 years and straight line that, because technically, what are you really doing? You have a stand ready performance obligation, meaning you just sit there and let your systems run all day. And if you're doing that and that's really your obligation, why should it be lumpy? And to me, when I heard that, I was like, that's insane. Like, the only thing that's going to happen is
so insane.
every single quarter, you're 100% going to be wrong. Always, because no one predicts the future. That's just how life is.
Yeah, years and some change.
Yeah, there's going to be a pandemic. We're going to go to war. I mean, I think we can all calmly say we have no idea what's going to happen. And so part of when I was at KPMG, we had actually brought all those companies together. We brought together the national offices, the auditors, and it was actually a really nice show of how industry can come together to say that is not the economic substance of what we're doing here. I don't care what's written in the standard. Let's get to a place where the conceptual words match the economic substance, because we all actually want that. And so the best win-win is that we can navigate through all the crazy words in the standard. And I think both you and me know, like, the usage and consumption, like how you get through that in the standard is you have to jump through all 5 steps, not sequentially, and back and forth.
Yeah,
and so
that's right.
I don't know how many accountants can do that in the standard. And I'm not saying I'm the best, or, I'm just saying it takes time and it's a lot of words. At the end of our project, when we were fighting that implementation and that interpretation, we used this, I'm not going to say it's loophole because I think it's there for that reason, which is under variable consideration, there's the allocation exception.
The allocation objective, what is it, like making sure you don't over-recognize a given?
Yeah. It's funny because when I was saying that, the words allocation objective are both so conceptual that I was like, does that mean anything? Anyways, yes, the allocation objective.
I ask that all the time in accounting.
So, right, it's basically saying, there's the hotel example, which is if a hotel night is worth this much on this day, but increases the price on this next day, or decreases the price on this next day because there's the World Cup or the Olympics, right? Isn't that the value of that day? And so the thought process was, if the value is what the value is on that day, and you can argue that through all of those crazy words of the standard, then you're like, oh, well, actually, the usage or consumption that day should be allocated to that day in a series of performance obligations.
Yeah.
And so, that's how that was argued at that time. And I'm so glad, because if you think about that arc of 30 years versus the 5-year thing that you mentioned, or, 3 years, right? The only thing that we know is that you cannot forecast that properly. And maybe 30 years was easier to say that is insane. And as you get shorter, you're like, well, shouldn't you just get better ML, right? Or like, what about AI? Can't it, sure, yes. But what are we really doing here? And I think that would be really interesting to dive into, because that was a lot of the thought process of how can industry come together to articulate the economic substance of something better, so we can get to accounting interpretations that, one, each individually don't have to pay for, right? When we all benefit if we can all agree on something and just move forward with it. It's also better for the SEC. It's better for the companies. That was a lot of the thought process of, can that be replicated in industry? And that was kind of the thought process of bringing together the community.
I would love to pick your brain too, more around that. So we've been talking now for an hour 10. I would love to find more time and figure out what we do next from this, but hopefully it was beneficial, for everyone. And then maybe we can stop the recording and figure out where we go from here. Does that sound good? Appreciate you taking the time for this. Thank you.